The best way to make your dreams come true is to wake up. That's a quote by Muhammad Ali. And my goal is to help promote that awakening. 3 of my favorite words for describing how to best invest over the long term are consistently not stupid. It seems like a pretty low bar as far as just trying not to be stupid. But we're people. I've done a whole lot of dumb things in my life. Those 3 words, to a certain extent, come from Charlie Munger. Charlie Munger was the partner, the former partner of Warren Buffett with Berkshire Hathaway. And he attributed much of their success. He said that a lot of their success was not due to being geniuses or smarter than everyone else. It was due to just simply consistently not being stupid. And it's an important point, especially right now. Let's use a simple example. If you make 20% per year for 3 years in a row, which would be amazing, that would make you one of the best investors. Maybe it doesn't sound that hot right now, but 20% a year, every year, for 3 years in a row, would be an impressive track record. And then you drop 50%. So you do maybe one little dumb thing after plenty of moments of genius. After all those moments of genius and that one moment of stupidity, you are down roughly 14%. So again, you had a hell of a run, and now you're down 14% because of one moment of stupidity. Now, why that matters a whole lot right now is valuations in the market right now are pretty crazy. The S&P 500's forward PE of the top 10 holdings is 20 to 30% beyond the peak of the tech bubble. And a lot of people are somewhat indiscriminately putting money into the S&P 500 despite that. And putting money in the S&P 500 worked really well throughout history, really, but certainly over the last 15 years. But this might be a moment to really think about, do you really want to put a bunch in right now? Now, a few examples. Apple is trading at a PE of 38. Over the long term, Apple's had basically an average PE of 14 to 15, price to earnings ratio. And so that means that Apple could drop 50% tonight, and it would still be roughly 25% overvalued. It wouldn't be cheap. It could drop 50%, and it wouldn't be cheap. It would be 25% richer versus the average. And Apple is, I think, roughly a 6.3% weighting in the S&P 500. So it's one of the biggest holdings. Microsoft, another excellent example. Microsoft is an awesome company. Seems to somewhat be winning the AI battle at the moment, certainly within the Mag 7, but it's trading at a price to sales of 14. To quote one of my favorite financial market quotes, Scott McNealy, the former CEO of Sun Microsystems, was at one point getting a hard time for people losing their money after the tech bubble. And he said, look, I was just running the company. You're the one that was paying 10 times price to sales. That meant that we had to return every single penny of revenue over the next 10 years for you to just simply break even. That's not to make money. We had to return every single penny of revenue for you to break even over the next 10 years, which assumes that we have no employees. We run a big company. We got a lot of employees. It also assumes that we have no costs. We're a tech company. We have to constantly be innovating, and there's a lot of R&D. And it also assumes that you don't have to pay taxes. If you don't pay taxes, you go to prison. So I don't really want to hear about what I was doing when you were paying 10 times price to sales, and Microsoft is 40% higher than that. Now, maybe it works out. It's a dynamic time with AI, and maybe that's justified. But the main thing is, what if it doesn't? And so it's really just a matter of balancing that risk and reward. Again, Microsoft could potentially drop 70%, and it would still be historically significantly more, uh, it'd be trading at a significant premium to the average stock historically. Another example is Tesla, which has a PE of 250. That means that if you invest $1 in Tesla today and it's not growing, which, it could grow a lot, but right now, if you invest $1, it would take 250 years for you to get that dollar back. That's what a PE of 250 means. Now, if it grows a lot, then that time frame shrinks, but still, it's a lot of risk. The average PE for the S&P over the long term is, let's say, 16 or so. That means that Tesla is trading at roughly 15x the average company, which means that it could drop by, I don't know, 93% or so, just to be priced roughly where the average stock has been priced historically. And I'm not saying that's going to happen, just simply that it could. Apple is, again, a 6.3% holding in the S&P 500. Microsoft is a 6.4% holding in the S&P 500. Tesla is a 2.5% holding. You add up just those three companies, again, with very significant downside risk, which I'm not saying is going to happen, but you will be investing 15% of whatever you invest in the S&P in those three companies, which said those three companies could decline 70%, and it wouldn't be a big deal. They wouldn't be a steal. It wouldn't be a big deal, and they could drop 70%. And that is, that excludes all the other companies that trade like it. And all that is to say, just simply, it's important to be consistently not stupid. If you have plenty of your net worth invested in the S&P 500, in the Magnificent Seven stocks, maybe think about whether you want to indiscriminately put a whole lot more in it. And definitely, just the other day, I believe roughly 30 5x levered ETFs just came out on individual stocks. Stay very far away from those. The Psychology of Money is an excellent book. And one of the things that it really focuses on is not using margin, because if you use margin and you're stupid, it can wipe you out. With a 5x ETF, you drop basically 20%, you're down to zero. Everything's gone. So this in particular right now, focus on being consistently not stupid. Play it safe, and you'll be much happier down the road. Maybe you'll be a little less richer, but maybe you'll be a whole lot richer and you'll be a lot less stressed.